I was reading an article a couple days ago about China and how their EV, they have an electrical vehicle problem that they actually don't know how to handle.
What's their problem?
They're producing so many electric vehicles in these government-sponsored companies that compete against each other that they're driving the prices down so low that everyone's losing money. But
government controlled.
Because the fact that it would cause great unemployment to lay these people off, they get in these spirals. The same thing they did with the real estate thing.
The housing.
The housing, right? It's just like
I don't know where the housing is, right? Because that was in the news every other day for a long time, and I don't read much about it.
Yeah.
I still see photos of cities that are completely empty.
Well, because most of the companies have actually the three biggest ones have closed down completely, and they're writing them off.
And then suddenly these CEOs disappear too. That's right. That happens in China too.
It's weird.
Yeah, your business doesn't go well, and suddenly you're in
say something wrong. But so I was thinking about this. I read this article, and then I love YouTube because you could go on and just any subject you want to watch a little video on, you can, and then you got to look
anything.
at this. I watched a movie on how to grow pineapples and how do you grow pineapples and then how do they pick them and how do they put them in cans.
That sounds fascinating.
It was fascinating. But so I was thinking about this, and then the very next day I read in the Wall Street Journal.
Thinking about the pineapples or thinking about the EVs?
EVs. Sorry, I'm jumping around here. And I see Elliott Management takes a stake in PepsiCo. And I see they take a stake in PepsiCo, and I think, I love capitalism. I love it, and this is an activist investor, and I think this is beautiful.
You love following the activist investors?
Yes, because what it does is stops these things like that happen in China where these organizations get away from themselves and forget that they're serving a shareholder, right? And that, it's happened with the DEI, all these things where all of a sudden they're like, stop, everyone just stop.
Well, for a while, remember, Pat, it was not many years ago, they were talking about it's all these different stakeholders. It's not just the shareholders. You have to, all these other things. And part of it,
that's true to a point.
It's true to a point, but if you're not delivering on the shareholders, that capital is going to go to your competitor who does deliver it for the shareholders.
That's why, to a point. Once you deliver to the shareholder, then you could spend time on, obviously around the rules. You can't exploit the environment or people or whatever the word exploit means, which is always the problem. But then I thought to myself, what a contrast. I mean, this is why we bet on the U.S. stock market. Right? This is why you bet on the U.S. Why you bet on broad baskets of stocks and not individual ones is because of exactly things like this, which is, look, PepsiCo, if you look at its performance and then what Coca-Cola did to itself 7 or 8 years ago when they re-engaged their franchisees and actually changed their business model, Elliott Investment puts $5 billion.
Is Pepsi not done well? I pay no attention.
It has not done well. And it's a huge conglomerate. I mean, it's massive.
They own all kinds of...
Yum Brands spun off of PepsiCo. Yeah. In fact, when I was in college, I thought I wanted to go to work at PepsiCo. Just because.
Really?
Because I just thought they were so brilliant.
All the corn syrup they can deliver right to the marketplace.
Look, they're selling sugary drinks for lots of money. And then Frito-Lay, and then at the time it was Kentucky Fried Chicken and
all the healthy foods,
all that stuff. But I thought this is why you bet on a capitalistic system and why over time it actually does well over time.
Well, the free markets, it's a beautiful thing. Either you are adding value or you're not.
And who decides what value add?
The consumer.
And without the government telling them what to make.
When the government starts telling them what to make, that's when we have a problem.
Which is what we talked about
My belief. That's why you look at what's happening in New York on the election and people thinking, well, rent freezes, like how does that work? Look, I've got a colleague, he says he just got rid of their last rental house in California. Been in real estate forever. He says he was never going to own another rental in California the rest of his life. None, not one, because of the amount of regulations, the how hard it is to evict someone. He had someone in there for months and months and months without paying the rent. Had all kinds of false claims, claimed there was mold, claimed there's rat infestation, everything you can imagine. And there's attorneys that'll take these cases on, buried them in legal done.
That's your point, right? Capitalism. In government regulations, right? So the person, it doesn't mean they're not going to own a rental. They're just not going to own a rental in California.
Correct. That's exactly right.
Right?
You're going to do somewhere where you can go build a house without,
Yeah. But this is why, so when you invest in the stock market, right? And the reason we're talking about this now is we used to do these things with our clients years ago called the lifeboat drills, which we would actually bring them through false scenarios.
We still do that.
Oh, we do.
Yeah. Stress test the portfolio, and here's what it would look like during these various times,
and not percentages. Show them dollar amounts.
Right, because if you have 10,000 saved, you lose 10%. It's $1,000.
Yes.
You have 10 million saved, you lose 10%. Suddenly, it's $1 million. You're thinking, "Holy crud! I know how hard it was for me to make that money."
Yeah, and immediately you convert that $1 million to what you made on an annual basis, and you think about the years of labor. That's how the mind thinks. Most minds think that way. And so, but in reading, just in over a 2-day period, I was thinking about this China and just this terrible system they have on allocating capital. And then the very next day, reading this article about Elliott Capital Management taking a stake in PepsiCo and the management.
The difference between government coming in and trying to solve the problem, the other is free markets.
It's free markets. And the people at Pepsi are just not happy about
this.
And
when they talk about these sort of investors with like Elliott, they raise capital from other outside investors. They say, look, our job is to find underperforming companies, buy a big enough stake so we have a seat at the board, shake things up, get them to be running well again, and then we'll exit our position.
Right.
And then we return money to our investors.
Yeah. And sometimes they get a bad rap because they shake things up, and I think this is brilliant. I love this. Which is why you should be an investor in the U.S. stock market over the long term. Because the market finds itself a way around. And who is the market? It's collectively all of us. But the smart strategies emerge.
And it's hard to know what tomorrow's winner is. How do you know?
That's why. Well, keep reading. Like I read an article this week about the price to earnings ratio on the S&P 500 being the highest it's been since. But then it's talked about how it's being driven by just a few companies. Well, and that's dangerous. But I thought, well, the counter to that is
worse, right?
The counter to that is that there's a lot of the companies that are up and coming that haven't been able to produce, that haven't caught on in the marketplace, which is a great counterbalance. If the
top performing companies, how many were even existed 20 years ago?
Not many of them, or they were unknown. Yeah, no. They weren't. Kmart wasn't the top producing, and Sears Roebuck wasn't the top producing.
Apollo Lepesco, who we've had on this program before, he's great. He described the stock market. He says, "Well, it's a place where you can own a company that you didn't start. You can own a piece of a company that you didn't found, and that's a good way to look at it because somehow it's like a casino. No, it's really not. And it's like the older I get, the more I'm like." I really do love equities.
I do.
Because
you can make an argument why 100% of your portfolio should be in equities. I could make an argument against it too, but
I remember meeting a guy at a conference. He had sold his business. He invested 100% of it in the Vanguard S&P 500 fund.
That's a little.
He said, I don't know if it was good or bad, but I know it works fine for me. And I thought, it's going to work out just fine for you long term. From a tax standpoint, it's really efficient.
Step up
most
in
of it's
basis.
capital gains. Step up in basis when you pass.
It
qualified dividends at a lower tax rate.
It probably produces enough that
income.
That's
right. I'm like, how do you argue with that?
It works. Anyway.
Yeah. Well,
thank you for listening to my rant because and then I think about we should have Apollo Lepesco on again. We don't have a ton of guests, but he is. Because when I was thinking like that, I was thinking, this is what's his name said. Apollo said this about the markets. Yeah. And it's not everything you invest in is going to be a winner.
No. Years ago, Pat, I used to own this. This was 30 years ago. This mutual fund, some global mutual fund, and I kept it longer than I needed to, in part because I liked their annual report. I realized I could have got their annual report, but anyway, it kind of kept me a little more motivated to be involved. But their annual report, they would list their top 10 performers. Right, this one up 800%. This one's up 700%. Then they would list their bottom 10.
Good for them.
Bankrupt, right? And I liked it because I thought this mutual fund company has a team of analysts. They go in, do this research. They fly all over the globe, visit the management team. They make investing decisions that led them to the top 10 performers as well as all the ones that went bankrupt. The same people. Which is the danger of trying to pick individual companies, which is, I think, why most financial advisors like us talk about the importance of being highly diversified. So